Futures very fractionally lower. We're essentially at records in the stock market. 30 minutes until the start of trading. I'm Bonnie Quinn. Danny Berger is off today. Bloomberg open interest starts right now. Coming up, Intel offering $15 billion in common stock as it races to capitalize on booming AI demand. Meanwhile, oil advances as President Trump leans on financial pressure while Iran rejects talks. All of that as stocks hover near records ahead of the latest inflation data later this week. Let's get to some individual market movers now. First, let's take a look at Apple. It's been downgraded by Jefferies. As you can see, we are at underperformed for Jefferies and an underperform today on that stock itself, with that stock down about 1.4% in the pre-market. Meta Platforms, though, a different story. It is higher. It's just released a new AI model that developers can download and run on their own computers, a home computer. The company's stepping up its push into open source AI. And Intel down almost 5% of the pre-market. It's raising $15 billion through a common stock offering, though, not debt, to help keep up with growing demand for its AI products. Let's begin right there and bring in Bloomberg Tech's Ed Ludlow in San Francisco. So it's choosing to go the stock route. Ed, you might say, well, obviously the stock has tripled. At the same time, this is going to dilute and investors are clearly not happy. Why?
Yeah, I mean, well, the stock down 5% on that dilution factor, clearly. You know, this is timing and being opportunistic for Intel. You're right that the stock has tripled year to date. And it helps them to fund a $20 billion capex program. So it is a $15 billion equity offering, but there's a 30-day underwriter option, which could add another $2.25 billion. So the total $17.25 billion. And if you just go back to what we learned last quarter, the data center business is growing 59%. It's a CPU story, but they're basically saying there's a great opportunity here in the AI world for Intel. And so knowing that their capex commitment for this year is $20 billion and it will go up in the coming years, this is them funding that.
Let me move to Meta, because we also just got the news that it's releasing Muse Glimmer, which is an open source model that anyone can use. Is this a land grab, essentially, a territory grab?
So bigger picture, Mark Zuckerberg, the Meta CEO, wants AI to be accessible, more democratic, more evenly distributed to everyday people, not just a few handful of companies. So with Muse Glimmer, this is a $30 billion parameter model, but the idea is you could just run it on your laptop. Just need one single GPU. Everybody could do it, not just in aggregate in a big cluster in the data center. And that's kind of what Meta's plan is, right? They've historically backed open source and open weight models as being a big necessity. But this is them kind of reinforcing that idea that they want AI to be accessible. And in this kind of memo, Zuckerberg outlines these 4 principles of how AI is more democratic in that sense. But it was interesting to see the stock push higher once Meta had communicated that.
Yeah, and it's unrestricted. It's certainly going to be an experiment. The other thing that Meta announced is that it's going to invest $1 billion in areas of the country where it has data centers and so on. Will this do the trick, PR-wise?
It's called the $1 billion Future is for Everyone Fund. And I think the idea of the $1 billion is to invest in those communities where there are data centers in proximity, you know, rather than the data centers themselves. And, you know, I think going into the midterms this year, there is a great consciousness among those in key races that the electorate is not sort of very pro-AI when it comes to the negative impact of data center build-out, which ranges from higher electricity prices to water availability impact and just basically the activity that's going on. So Meta are addressing that head on because Meta, one of the biggest operators of data centers in this country.
Let me ask you about Apple. We obviously saw the downgrade from Jefferies, but it's also looking at reinventing basically the watch, the smartwatch.
Yeah. Yeah, so Mark Gurman's Power On very much focuses that Apple is going beyond the screen, or getting rid of the screen in some cases, having products that don't rely on that part. Where it relates to the Jefferies downgrade is that Jefferies is pretty concerned about Apple's ability to raise average selling prices overall. One part of that strategy is what Jefferies describes as the 20th anniversary all-glass iPhone. Remember, Bloomberg's Mark Gurman has been all over this for 2 years. Project Glasswing, the idea that it's just a very high glass content phone. And what Jefferies is saying is that in their supply chain checks, they don't think this all-glass iPhone is going ahead because Apple cannot guarantee that it will be able to have volume yields at a level that make it sustainable, production yields that make it a worthwhile project and product. So the stock did fall, right? We're down 1.4% in the pre-market, but the moment that the note hit, the stock went from basically being flat to that decline. So clearly it's being taken seriously.
Yeah, absolutely. Ed, thank you so much. That is Bloomberg Tech's
Thank you.
Ed Ludlow. This week, investors will get a fresh read on inflation and the health of the consumer with the latest CPI print. Joining me now is Michael McKee, Bloomberg's international economics and policy correspondent. So, Michael, if we get consensus readings, right, which is for, again, inflation to come in above target, the optics may not be great, but at the same time, if Warsh is putting less emphasis on CPI, does it matter as much?
Well, we don't know that he's putting less emphasis on CPI. He's mused about other indicators, and the Fed is always using every other indicator they can find to figure out what's going on. But for right now, it is the CPI because it's the most detailed view of inflation that we get. So they'll peel that apart and try to figure out where inflation is still a problem. We get that on Wednesday. Thursday, we get pipeline inflation, what's happening with PPI. And Friday, the Michigan sentiment indicators also show the idea of inflation expectations, and that will be important to the Fed as well. So we can call this inflation week. Now, what everybody's going to look at once they strip apart the CPI is what they call the CPI supercore. We used to talk about this a lot, haven't in a while, but it's basically services in CPI X housing because of the way housing is measured. And as you can see, it has still, even though it's come down some, it still remains sticky. That is the blue line is the year over year. And so the hawks want to see that come down solidly before they say we're going to get to 2% or not. Interestingly enough, Ani, we have not very many Fed speakers reacting to any of this week. We've got Beth Hammack today, and then she'll speak later in the week, as will Tom Barkin. But you see how many we had speaking last year at this time. Big difference. Don't know if it's Kevin Warsh's influence or if people are just on vacation.
For August, the calendar does seem to be quietening down. Michael, thank you so much. That is Bloomberg's Michael McKee. Turning to the Middle East, President Trump is leaning on economic pressure rather than fresh strikes on Iran now, as Tehran rules out direct talks with the US for now. Joining us is Colonel Wayne Sanders, Bloomberg Intelligence Senior Defence Analyst and retired Army Colonel. Colonel, sure, the IMF is projecting 6% contraction for Iran for the year. We have reports of runaway inflation, people below the poverty line and so on. At the same time, this is causing economic pain in the United States as well, and we're just 3 months away from the midterms. How long can the US bear this?
Yeah, I think at this point in time, that's kind of the game that we're playing right now, is a game of chicken economically. The U.S. can still, from a military readiness perspective, do quite well. I know that people are talking about munitions depletion, but that's only a specific handful of capabilities, while the rest of the weapons stockpile still remains well. So I think it's really going to be along the lines of more on the political side of the house as to how much more the U.S. population is willing to continue to go back and forth. Hey, we almost have a deal, or we don't have a deal, and then obviously, we're dealing with the Houthis, the Iranian strikes, and then IRGC just changed over as well. An additional IRGC former commander is now in charge of the National Security Council in Iran as well. So 2/3 of that Hydra now kind of changes. So you still have the president, but then IRGC commander, and now the National Security Council. All three of them kind of have to agree if you're trying to reach some type of agreement.
Well, domestically, according to reports, the Pentagon has given several defense companies 21 days, no more than 21 days, to come up with fresh solutions to some munitions shortages. How can they ramp up the production of munitions if this has been a problem for a while and they haven't been able to do it?
Yeah, the needle has already started to move. We have seen that. Right now, RTX is being asked for their standard missile series, the SM-3, SM-6, to double and almost triple their capacity. Lockheed looking at their PAC-3 interceptors for the Patriot, as well as the THAAD system, triple and quadruple their rate. So they've already started doing that. They've started pushing towards 620 is the PAC-3 interceptor numbers right now. trying to make it all the way up to 2,000 over the next 7 years. Obviously, they're going to reach that before then, but it's not something that takes place overnight. Really what Deputy Secretary of Defense Feinberg's asking for right now is looking across the supply chain, whether it's solid rocket motors, whether it's batteries, whether it's some of these other additional components, working with their Tier 2, Tier 3 suppliers, and then finding out whether or not there's innovative solutions to bring down that number as well. You also saw Secretary of the Army Driscoll put out that they're changing up test range requirements to bring in some of these munitions earlier into the process as well. All of those things, I think, will help bring capabilities to the left. Tech disruptors are involved in this as well. You see Anduril, Enlidos, Co-Aspire, Castilian, and Zone 5. They were given a low-cost containerized munition demand as well to say we need to be able to up-ramp that as well.
All right. Colonel, thank you so much for joining this morning. That's retired Army Colonel Wayne Sanders of Bloomberg Intelligence. Let's get a check on markets now. About 20 minutes before the opening bell, as you can see, we are fractionally lower on futures, but the S&P 500 closed Friday at a record, as we saw a gain for stocks in general. The Nasdaq itself was up more than 1.2% of the stocks, now up 75% year to date, although it is down 16% from its June highs. As you can see, Nasdaq 100 futures also pointed fractionally lower. The 10-year yield up another couple of basis points today, 467.19. That yield is creeping ever higher, even as markets price out to some extent the possibility of a September hike. We're still at about 45% probability of a hike. And then if you look at Brent crude, well, that is partially to blame. We have Brent back above $85 a barrel now, as it looks like there is complete stalemate with perhaps Iran and Oman coming to an agreement, but nobody else. All right, let's get a look at some other movers on our radar with Bloomberg's Nora Melinda.
Good morning, Vonnie. A few stocks on the move this morning. First up, GameStop might just be rethinking that deal with eBay. Sources are telling Bloomberg CEO Ryan Cohen is considering pulling his $56 billion offer for the company, and he might propose a partnership or JV instead. You're seeing shares of GameStop to the upside, up about 2.8% in the pre-market trade, though. We are seeing shares of eBay down a bit more than 1%. And from there, we're heading over to HPE, higher after an upgrade over at Morgan Stanley. Morgan Stanley is saying that the company, it likes it and all that AI spending. It keeps rolling in. Vonnie, I guess that AI spending story gets a pass today, apparently. Shares up about 4.8% this morning. And finally, TSMC lower. That's even after monthly sales jumped 45%, thanks once again to strong AI demand. Last month, we know the company already raised its spending and revenue outlook for the year as big tech companies keep pouring money into artificial intelligence. Apparently, even a 45% jump isn't enough to impress investors these days, Vonnie.
Was considered even a little light. Isn't that interesting? Nora, thank you so much. That's Nora Melinda there. Coming up, Berkshire spends $4.5 billion on share buybacks as Greg Abel puts some of its cash pile to work. We'll have more on that next. This is Bloomberg Open Interest. Now to high interest to look at what's making headlines around the world. President Trump naming White House Staff Secretary Will Scharf to be his top lawyer. Scharf is set to replace David Warrington as White House counsel next month. Since Trump began his second term in office, Scharf has become known as the person who hands him executive order documents in the Oval Office. Israel is rejecting a US-backed peace proposal with Hamas. Prime Minister Benjamin Netanyahu told his cabinet the Israel Defense Forces will not carry out any withdrawal until Hamas is, quote, genuinely disarmed. President Trump has touted the proposal as an historic agreement. Berkshire Hathaway's latest earnings report revealing that it has spent about $4.5 billion to buy back its own shares and purchased nearly $20 billion of equities in the period. The increase in capital deployment signaling that CEO Greg Abel is putting more of the firm's cash pile to work. Joining us now is Bloomberg Investing editor Amanda Cantrell. Amanda, thanks for joining. So the fact that we got a decent-sized buyback, and we haven't had a decent-sized buyback in quite some time from Berkshire, does that mean that suddenly the shares look intrinsically undervalued?
Well, they do to Greg Abel, at least. He did say at Berkshire's annual meeting in May that they would start engaging in buybacks once they felt that the intrinsic value was above where the market was pricing it. And clearly they do think that's the case. They sort of stuck a toe in the water in the first quarter. They bought back about $235 million. Obviously, this is a big step up Still a little bit below what some analysts were hoping, but there is some indication per analyst that they have been buying back some shares in the current quarter.
Now, the stock is up 20% in 2 years. The S&P in that time is up 45%. I think one of the reasons everyone is so interested in this is because they want to extrapolate and say, well, that means the broader market is perhaps not overvalued or too overvalued. Can we extrapolate anything like that from this particular action?
Well, it's with Berkshire, you know, they are sort of a bellwether for the U.S. economy, given all of the various business lines that they're in. We know for sure that they feel like their own stock is personally a buy. They also, this past quarter, bought $20 billion worth of equities, which is the first time they've been net buyers of equities in some time. So that does seem to indicate that they're finding something of value to buy.
And hopefully we'll know more when we get details of those filings.
We will know more when their next quarterly 13F filing is due, yes.
We do know, though, that they upped their Alphabet investment. Now, does that signal that Greg Abel is just more comfortable with technology investments? Alphabet is undervalued. What does it mean here?
So it's interesting. Warren Buffett actually took credit for that, thinking of that investment on an earlier TV appearance. I think he's has expressed regret in the past for not investing in it sooner. So clearly they do think there is some value there.
Greg Abel, obviously quite happy to sort of come out swinging here. Also the acquisition of Taylor Morrison, and then the continued love affair with Japanese brokerages and insurers.
That's right. They did acquire Tokyo Marine. That's one area that they definitely see as a bright spot, Japan's.
Amanda, thank you so much.
Thank you.
That is Amanda Cantrell there, our investing editor. Coming up, strategists continue to boost year-end targets as earnings season wraps up and a Fed rate hike looks maybe unlikely anytime soon. Aoifinn Devitt joins us next to discuss. This is Bloomberg Open Interest. JP Morgan strategists, the latest to raise their S&P 500 year-end target. They see the benchmark topping 8,000 by 2027, up from 7,800, which is basically where we're at now. JP Morgan says AI monetization is accelerating, and that will boost profits for hyperscalers before broadening out to other industries. Let's bring in Moneta Global Wealth Managing Director Aoifinn Devitt. So Aoifinn, does this seem plausible that we will not have any kind of a major drawdown, at least imminently, if we're to reach 8,000 by year end?
Well, interestingly, that was my forecast at the beginning of the year, 8,000. It seemed a little outlandish at that time. I think increasingly more likely now as the year builds some steam. What could we see? I mean, I think in a way, every potential threat that could be thrown at markets has been thrown at markets. It has been shown to build resilience, to the point of which commentators are suggesting resilience is not always a good thing, because it suggests that there is a lot of hardship out there and a lot of challenges. But we've seen that markets are resilient to tariff threats, to geopolitical threats, to a high oil price, and to a really shape-shifting Fed. So at this point, we've seen that definitely a lot is riding on earnings. And I think that's probably still could be the chink in the armor here, something unraveling when it comes to AI earnings. But I think now with a mere 4 months left, 4 and a bit months left, I think we could be looking at a fairly steady run to 8,000.
Aoifinn, this seems to suggest that monetary policy won't be an issue, and yet the market has never been as confused about what's happening next at the Fed, right? So yes, it took in its stride, perhaps, as you say, the shape-shifting nature of the Fed, but we really haven't fully digested that yet, and there are 2 more meetings before the midterms and more after that before the end of the year.
Well, certainly we're not getting many signals, and that's by design. And that, I think, has thrown markets a little bit. We know that the bond market was really not taking the chairman's word necessarily and did not think that there would be much inroads made on inflation. Now it seems they're a little bit more calm about that prospect, and it seems that the prospects of a rate hike now have come down significantly. We're looking at one move in either direction, and I'm not sure that that really signifies a particularly strong direction of travel. So for that reason, I think some of the most extreme projections have come into line around monetary policy. Maybe that's why there's a bit more calm out there in the bond markets.
Aoifinn, you say that we've managed each challenge as it comes along, and the market has just completely dealt with it in a very calm way. But each next incremental record that we hit, are we putting ourselves in a more precarious position?
A great question there. I'd say what we're seeing is more profit taking, certainly as we hit new highs. And we're seeing more rebalancing. We've seen that for some time, rotation out of the hyperscalers into different parts of the AI value chain at times, and into other sectors such as the European stocks, for example, some of the old economy stocks, some of the healthcare at other times. So we're certainly seeing this rotation happening, suggesting that there is money being taken off the table.
If we get a rate hike, either in September or in October, what does that do to the rotation trade?
I think that accentuates the rotation trade out of some of the more high volatile, hyper growth stocks and into more defensive stocks. I think one thing we do know is there is no bottomless pit in the world, even in the world of AI, even in the heady world of AI. There is still a need to raise capital. And we know just from some of the messages coming out of Meta today that the pricing at which even these hyperscalers can raise financing is increasingly getting more and more expensive, which is good news for the private credit managers providing this financing, but it shows that there is going to be a higher price to pay for borrowing. And as we see rates go up, that price is going to be really have a higher floor underneath it, which will put pressure. If it puts pressure on the cash-rich hyperscalers, think of the pressure that would place on the ordinary midstream corporate that also needs to borrow. Think of the pressure that would place on the consumer already at the pin of their collar with their mortgage. So I suggest it will be a very unpleasant message that we get should rates go up.
All right, Aoifinn, we are going to continue this conversation just on the other side of the market open. Aoifinn Devitt is sticking around. Let's take a look at those markets now ahead of the opening bell. Just 30 seconds to go. And we are coming into Monday at a record on the S&P 500. Will it hold? We'll see. We're down, but very, very fractionally, just 0.1%. A few stocks under pressure today, including Intel, for example, on that dilution announcement. But also oil is higher today as we continue to see a standoff, basically, in the Middle East. Brent crude above $85, and that surely will have an impact. And yields are higher, with the 10-year yield now at 4.68. Moments away from the start of trading this Monday session. This is Bloomberg Open Interest. I'm Bonnie Quinn, stepping in for Danny Berger. And you can hear the opening bells right now as we see stocks fractionally lower in the pre-market. This, of course, as we're coming into Monday at a record for the S&P 500. The stocks as well was up 2.2% in Friday's session. All right, let's get to see those opening bells and who exactly is ringing them. We'll start down at the NASDAQ. We have Advisor Shares, actively managed shares. That's Dan Aarons there, portfolio manager at Advisor Shares. They do thematics, so things like psychedelics, cannabis. I saw an HVAC ETF there earlier on. So congratulations to them ringing the opening bell. And then on this side, a 65-year celebration. So JB Hunt, the transportation and logistics company, celebrating 65 years. And that's the president there, Shelley, celebrating with her team. She has a commentary in Fortune today, if anybody would like to read a little bit about the history of JB Hunt, one of the oldest companies in the United States as it stands right now. All right, let's get to some stocks to watch as we begin just the first few minutes of this trading session. Apple down 2%. It was downgraded at Jefferies, down to underperform, in fact. Jefferies supply chain challenges for higher priced iPhones. Meta up 1.2%. This is interesting. It's just released a new AI model, an open source model. Developers can download and run it on a home computer. Anybody can download it. It's going to help with things like file management and so on. The company stepping up its push into open source AI and trying to gather those eyeballs for that before anybody else does. And then Intel down 4.5%. That's likely to put some weight into the averages today. It's announced basically a dilution. It's raising $15 billion or so, it hopes, by sending some shares into the market, some common stock into the market, and that is Intel down about 4.5%, trying to keep up with demand for its AI products and obviously take advantage of the tripling in its stock price just in the last year. So with that in mind, let's bring back in Moneta Global Wealth Managing Director Aoifinn Devitt. Aoifinn, we've had this massive run up in these chip stocks, right? I mean, we're talking about the semiconductor index being up 75% year to date, and that's even after a 16% drawdown. Can we stay at these price levels, or is there much more price discovery to happen to bring some of those, exorbitant levels down?
I would say we're getting pretty close to having had full price discovery there. There's a lot of uncertainty regarding all of this in the demand and supply areas. So I'd say, though, in terms of transparency, getting information out there, that these cycles have just got so short in terms of what analysts need to see. So I don't see much in terms of unknown unknowns. But what we will see is a continued rotation down the value stack. We've seen it go into the chips, and now I see it from here going firmly into the infrastructure and into the providers of finance, like we discussed earlier, the banks, where follow the money essentially when it comes to this. And then even at another area of abstraction into the power supply for all of this. We know that this has not been resolved, how we will power these data centers. That's where we see the next leg, shall we say, of this rotation through the value chain.
It all presupposes, though, the optimistic scenario presupposes that all of this build-out happens without incident, right? And we already know that states are putting up fights, communities are putting up fights, hence why Meta is offering $1 billion to these communities at the moment.
It is. It has become an arms race of sorts. Now it seems to become a sweetener race in terms of who can get there without causing as much disruption. We know this is a huge wedge issue. At times it has bipartisan support, depending on where you look across the US. Plus the elections are coming. And then there's this kind of rumbling in the background that we cannot get behind in this race in the US because China is not going to have the same level of restrictions, is going to have the ability to build data centers. And we know this race is on. I will say I'm sitting in Europe here, and Europe also knows it's in the race too, but perhaps it's lagging on a third place there behind the players I mentioned earlier. So a lot to play for. And I'd say we also forget that none of this is ever straight line. There is always going to be overextension and correction in any infrastructure build out. And I think that's an important reminder when we look back. If AI infrastructure build out is now about 2.6% of GDP, it's a massive slice relative to other industrial revolutions in the past. So it can be very meaningful, but there were fits and starts there too.
You mentioned Europe. Europe has definitely been an AI haven trade. What hasn't so much in the past several months, although recently it's becoming one, is gold. Why has gold been rallying just all of a sudden out of nowhere?
It's interesting. You mentioned some of the tensions and perhaps the threats to markets earlier that are circulating. I'd say gold has always been there as a hedge against currency debasement, against central banks not being able to control their deficits. And it really has been, it's at times has looked like a risk on trade when the technical factors suggested that it was retail money that was really driving this, as well as central bank holdings. Then it went out of favor, and it seemed that it wasn't marching in sync with equity markets. I would suggest that the strength we're seeing recently, up 7% last week, is a sign that it is starting to look like it's good old-fashioned diversifier hedge trade again. And it, again, I used the word shape-shifting. Maybe this is also shape-shifting in terms of the role it plays in a portfolio. But I think it is notable that investors are starting to realize that some of these problems around the budget deficits have not gone anywhere.
Yeah, and to that point, we're seeing bond yields rise quite substantially, right? Aoifinn, how concerned are you for, those with bonds in their portfolio that you manage, that we have yields just rising and not any end in sight? We have the 30-year yield at 5.21 and change now.
It's a great question. And I'd say at Moneta, we always have a bond slice in the portfolio. It's not huge. It certainly doesn't correspond with the old-fashioned notion of how much bonds you would hold in a portfolio. It has been running down over time. But the way we hold bonds is really more of a buy and hold strategy, a cash flow generator. We see it as a good place to leave cash. And because we have laddered bond portfolios, we're not typically forced to sell into a market as funds would be. So the way we hold bonds is slightly different, but we do have to manage expectations in terms of what they can yield and how volatile they're likely to be over the course of time. But having a laddered portfolio of municipal bonds is really a pretty safe haven trade for private wealth clients.
Aoifinn, is the surprise as palatable in Europe as it is here? And why is that? I mean, I feel like this market, or at least some participants in this market, have been waiting for long-end yields to rise substantially for a long time, given the fiscal situation.
I'd say in Europe, there is obviously the yields are rising for different reasons. There's a lack of confidence in some governments. We've seen that in the UK. We've seen that in France. Quite a lot of movement there around just the inertia in Europe, the lack of growth, this stagflation, a term that's gone out of favor now, but was in favor just at the beginning of the year. So I'd say there has been some concern about that rise, but also I wonder whether it's contamination and just this contagion from the rest of the world, or whether there's something very particular to Europe. And we hear advocates on both sides of that. So I wouldn't say there's a particular surprise. I'd say there's some relief that yields haven't gone higher, in fact, because a lot of Europe, as I mentioned, is anti-tech. this anti-tech index, a lack of growth, a sense of falling behind. There's a lot of negative, I'd say, headlines, but actually on the ground, more positive news.
Well, exactly. So Europe, it's quite obvious, I think, why yields are rising. And it is in the United States, too. It's just that they were so depressed for so long that I'm curious, why is there surprise that US yields, particularly long-end yields, are rising so much?
I think the surprise has come from the fact that the bond market has now taken on a life of its own again. It is no longer essentially obeying the Fed's direction. It's telegraphing. It is starting to act out on its own. The bond vigilantes in action, perhaps. And that's maybe where some of the surprises come from, that the bond market and the equity market are diverging in terms of the optimism that each is feeling. The equity market has been, we mentioned resilience, just boldly resilient time and time again. And it has captured trades with a lot of technical factors, money on the sidelines, a real tendency to buy the hype, believe the hope, and not stay out of the market, a sense of FOMO. The bond market has been really rebelling against that optimism for some time. So maybe the surprise has come from the fact that it is so resistant to that hype trade, and that it's really striking out on its own, and the fact that now that the Fed is not exactly giving guidance, it really is an uncharted path it can run the bond market right now.
All right, Aoifinn, a very comprehensive chat with you this morning. Thank you so much. Moneta's Aoifinn Devitt. All right, let's get a check on the stock market right now. As we know, the S&P finished Friday at a record despite that weaker than expected jobs report, although, as one guest pointed out earlier, the unemployment rate was not that weak. So we are seeing today a very fractional decline for the S&P 500, but will it hold throughout the day? We'll have to see. We're seeing plenty of energy stocks, for example, higher on Brent, above $85 a barrel. We're seeing the software companies continue to gain as well. It's this continued trend. You've got Palo Alto Networks, Palantir higher. We have Berkshire Hathaway rising 2%. And as you can see, the stocks that are doing well are doing much better than the stocks that are doing poorly. So you have 209 stocks higher, but they are higher by a bigger percentage point gain then these stocks are lower by a percentage point loss. Some of these stocks include Apple, a little maybe challenge ahead. Jeffrey certainly pointing that out, but Apple has been doing well. It's been doing just fine in terms of market cap. Nvidia just down about 0.5% as well, but also that's made back some of its losses in the last few sessions. Intel definitely weighing on this sector, and also the broader market today down more than 4% after it said it's going to dilute. But again, all of these stocks have had massive gains, so you're going to see probably a little pressure on the chips. But don't forget, we did have the SOX index up by 2.5% on Friday. Now for some sectors, let's have a look. As you can see, it's reflected there again. Energy, healthcare index, we're having some nice gains for some healthcare companies, including Vertex Pharmaceuticals, the financials, and then on the downside, the real estate index and consumer staples, as we perhaps get just a little bit more trepidatious about the consumer post that non-farm payrolls report. All right, coming up, traders leaning into momentum as leveraged ETFs take off, especially for chip stocks. We discuss with Eric Balchunas from Bloomberg Intelligence. This is Open Interest. Time now for our top calls. Here's Bloomberg's Nora Melinda with some of the analyst action in focus this morning, Nora.
Hey, Vonnie. First up, looking at shares of Apple, they're lower. That's after Jefferies downgraded the stock to underperform. Now, this is the latest sign that Wall Street's getting more cautious on Apple. Jefferies says the roadmap to a higher price iPhone looks challenging. Vonnie, as if iPhones weren't expensive enough already. Next up, Morgan Stanley upgrading HPE to overweight. The firm said it likes what the AI boom is doing for the hardware business and thinks that HPE is in a good spot to benefit. Vonnie, these chip makers can't have all the fun. We're seeing shares of HPE higher by about 3.5%. And finally, over to retail. Wells Fargo upgrading Dick's Sporting Goods to overweight. Shares of Dick's up about 1%. Believe it or not, Nike is actually part of the reason why. The firm thinks that Dick's could benefit from a Nike comeback. Well, there's still plenty of room to improve Foot Locker. And Nike could use that comeback, Vonnie. The stock is down more than 30% this year. Those are your top calls. Vonnie?
That's the thing. You have to have a chicken and egg situation with that. Does Nike have to make the comeback first? Or...
Right.
All right, Nora, thank you so much. Now to the leveraged ETF boom. The funds are adding to market volatility as traders profit from intraday momentum strategies. But the trend may be losing steam with total assets under these funds off their record highs. Let's discuss with Bloomberg Intelligence ETF analyst Eric Balchunas. Not tongue-in-cheek, but is it because so many retail traders have lost their shirts?
Yeah, well, it's very complicated. When you unpack the leveraged ETF space, which has been around forever, but it's gotten a little more risky with single stock leverage. But all told, it's about 160 billion. So that's 1% of all ETF assets. So it's a small area, but it accounts for 13% of all the trading, which is probably good. You should trade these things. You don't want to hold them because they have vol drag, because they reset every day. Long story short, the people who use them, I think, are using them pretty correctly. In the semiconductor space, which is where a lot of the volume is lately, Sissel is the big one, 3X semis. It's trading as much as like a Mag 7 stock these days. Like, there's a lot of activity. When there was a downturn, the people piled in. Then when it goes up, they take their profits. So all told, they've made money in the ETF, believe it or not. I know that goes against what people think, but these traders are smart. They do the opposite of performance chasing. They go in when it goes down, and they buy when it goes up. Now, if it kept going down, that's when they would lose their shirts. And there has been money lost, no doubt. But net, these things have made $60 billion for these traders. That's why they use them so much.
But is it all for Jane Street? I mean, the thing is, you don't know when going down is going to stop, right? That's the problem.
True.
Otherwise, you'd be in SOXS, right?
So part of this whole market is that the dips keep going up again. You know, the Vanguard people know the same thing. They just keep buying dips, and so do the degens. So like, people have been accustomed to dips going back up, and they keep going up. So you're right. Until there's this long, prolonged bear market, my colleague Athanasios, we refer to it as a hard rain. If there's a hard rain, a lot of this stuff will go away because it will hurt too much. But for now, as long as the dips kind of keep coming back, this will just keep, it's like chum in the water. Volatility is chum in the water for these traders who really love these products, and they deliver the leverage every day. And that's why, so I think they get a bad rap, and I equate them to like fast food or alcohol. They're not healthy, but they're legal. And, you know, if you want that quick hit and you're looking to trade, they do work day to day.
Absolutely. Bitcoin, it's been trading in this range, $60,000 to $67,000, you know, for months now.
Yeah.
The last catalyst really was that legislation back in October. Was it just overvalued then? And is this sort of its value now?
Yeah, I mean, the market says it's worth, what, 65,000? We called it the silent IPO. When Bitcoin got to 125,000, it had gone up 400% in 2 years. That's a lot. I mean, it doesn't go up that much normally. So it had to blow off a little bit. But a lot of the OGs who sat through multiple hellish downturns, I think, cashed out. I mean, they're a little older. So they probably were like, hey, I'm 35 years old now. I want to get some money to buy a house. I was
going to say 65. 35 is considered older in Bitcoin world?
Yes. Believe me, that's like a boomer right there for a Bitcoiner. So 35, 40, maybe they're getting a mortgage. So I think that we call it the silent IPO. The ETFs were kind of the IPO of Bitcoin. And a lot of the money went from the early people who were like VCs into the hands of institutions and people who use ETFs like advisors. So right now, the ownership of Bitcoin is changing more to advisors and retail and professionals and institutions, and some of these OGs have cashed in. Now, what happens now, we'll see. This cold card hack is fascinating. Somebody hacked an actual wallet wasn't even connected to the internet. That's scary. This, I think, will drive some flows to the ETFs. I think even the Bitcoiners are going to be like spooked by this and be like, you know what, honestly, I'd rather trust Larry Fink and BlackRock to hold my Bitcoin versus this Canadian company that had 5 employees.
Unless you're a believer and you just believe in decentralized currency,
you could do a little of both.
Go and give all your. I
agree. There are some real hardcore. There's different spectrum of believers. If you're really all in, that you could never give your money to BlackRock.
Never give your money to.
But there's people in the middle, or they put some maybe with an ETF, and then keep the rest on chain.
It's just a fascinating story. Eric, thank you so much. That is Bloomberg Intelligence analyst Eric Balchunas. And don't miss Eric on ETF IQ later today. That's at noon right here on Bloomberg TV. Coming up, GameStop may pull its $56 billion bid for eBay, but it has something else planned. More next. This is Bloomberg Open Interest. This is Bloomberg Open Interest, a check on stocks now more than 20 minutes into the trade. And of course, we finished at a record Friday after the jobs report. We are so far off our lows of the day that we are trying to be in the green here on the S&P 500. We had an upgrade in terms of a forecast from JP Morgan strategists. They're now looking for 8,000 by the end of the year. And certainly today, we may just see another record, although for now, fractionally lower. Same thing for the Nasdaq 100. We were up 1.2% on the Nasdaq. We were up more than 2.5% on the SOX index. And yet it's just less than 0.1% lower today, even as some major stocks do sell off. The Russell 2000 lower as well. The dollar index just a little bit higher. We do have, of course, in the background, the geopolitical tensions. Nothing seems to be happening, at least regarding Iran and the US, although there is an agreement between Iran and Oman, apparently. Still have to see those details. In terms of stocks on the move, Apple is lower. It's had some great times recently, but today it's got a downgrade from Jefferies on higher costs, and we know that Apple has been touting the fact that it's going to have to increase its purchase prices for many of its products. We also have Nvidia lower, that obviously the proxy for the AI trade. Intel down 4.7%. A little bit of dilution coming to Intel. $15 billion worth of common stock being injected after the stock price tripled in the last several months. Meta Platforms, well, it's coming out with $1 billion for communities that it's investing data centers in. And also, of course, secondary to that is that it's going to give you an open source AI cheaper model. In fact, it's going to be free. You can use it on your desktop at home or on your mobile phone even. GameStop and eBay, this is an interesting one. So GameStop very slightly higher, eBay down about 3%. Ryan Cohen changing his attitude just a little bit. Sources say GameStop is considering withdrawing that bid for eBay. CEO Ryan Cohen, though, may instead propose a partnership that would let eBay leverage GameStop's 1,600 US retail locations. Joining us now is Bloomberg's Bailey Lipschultz. Bailey, this is interesting because this might actually be in fact doable, whereas the previous suggestion didn't seem to be that doable.
No, that's spot on, Vonnie. This was a deal that, when announced, kind of went viral for all of the wrong reasons. If you're Ryan Cohen and if you're the members of that GameStop team, the big question was, how do you fund and take over? Again, not necessarily taking out a company, but going out and acquiring a company worth magnitudes more than you are worth. But this does kind of strike the kind of balance between what Ryan Cohen has been arguing is that eBay, poorly run in his view, really needs new blood, new life. And this is a partnership that, as Liana Baker broke out, could benefit both companies, because you're looking at eBay, which is kind of doing fine, and then GameStop really has these brick and mortar stores that they could benefit from selling products. So they've leaned into things like getting baseball and trading cards graded, leaning into other kind of levers to pull as people buy video games more and more on the system. So this could be a big step forward. As you mentioned, though, GameStop basically flat and eBay down about 3%.
Well, that's the thing. Does eBay need physical locations? I mean, wouldn't that change the business model entirely for eBay, which has been an online marketplace?
It certainly would. And I think that's why the argument of kind of a partnership, kind of balancing both prospects, because when you think about an online marketplace, what could you benefit from having brick and mortar? Is ability to kind of check out products? Is it an ability to use a third-party seller? When we think about the GameStop that people of my generation knew to love and also dislike, was the ability to sell and trade in video games. So you're bringing in a product to then get store credit to turn around and make another purchase. Is that something that Ryan Cohen is thinking about? Perhaps, but to your point, if you're eBay and the whole argument is to be an online marketplace, what's the point?
Yeah, I mean, I'd have to look at the Real and see what happened there, right? Did the physical location help for the Real? And maybe that might be some kind of an example for us. Can we talk about Intel? $15 billion in common stock. Is this major dilution? Is this something that will annoy existing investors? Obviously, the stock is off today, but not by that much. Really.
No, stock's not off that much today. Again, as you had mentioned, it's basically tripled in a few months. This was relatively not unexpected. This is a market where you don't raise when you need to, you raise when you can. So when your stock price is up 3x, and as we've seen with SpaceX, Oracle, and a number of other companies, kind of, and Google kind of top of mind, leaning away from tapping the bond market, they have a lot of capital they need to raise in order to build out Foundry and build out some of their other products and kind of the entire investment in the U.S. So if you're Intel, this is a good lever to pull to bring in equity investors and also raise quite a bit of money. Again, this would be more similar to the Google deal, where we're expecting it to price later this evening.
All right. Well, we'll see how the stock reacts throughout the week. But for now, at least, it's being digested somewhat by investors. That is Bloomberg's Bailey Lipschultz and all the capital markets action today. Coming up in the next hour, we're going to speak with Banrion's Shana Sissel on why she's so keen on alternative investments. Plus, we get a read on tanker traffic and Amazon's new freight services with FreightWaves CEO Greg Fuller. We are 30 minutes into the trading session. Welcome to Bloomberg Open Interest. I'm Vonnie Quinn. Danny Berger is off today. Coming up, Intel offering $15 billion in common stock as it races to capitalize on booming AI demand. Meanwhile, oil advances as President Trump leans on financial pressure while Iran rejects talks. All of that as stocks hover right near records ahead of the latest inflation data later this week. So let's get straight to that then and bring in Bloomberg's Michael McKee, Bloomberg's international economics and policy correspondent. It's not just the CPI, we're getting lots of inflation data this week.
Lots of inflation data this week, but CPI is going to be the marquee number because it's the one that drives all the headlines and consumer expectations as well. And what's interesting about this week and this month's data, the July forecast, is we're going to see, as you can note there, that inflation on a month-over-month basis went up from June, but the year-over-year is going to tick down because of base effects. The month of July a year ago going to fall out of the data, and that'll push inflation down just a little bit. So then the question is, what do the hawks on the Fed think about all of this? It's going to be hard to say because we aren't getting a lot of talk this month, but they do have another CPI report before we get to the next Fed meeting on February 16th. It's gasoline prices that everybody is watching. And of course, Vonnie, you were just mentioning that oil prices have gone up again. But you can see what happened in June and July. We got the memorandum of understanding in June, and oil prices fell significantly. Gasoline prices followed them down. And since then, they've been going back up, but they're not to the height of June's numbers, so gasoline prices are probably not going to add much, if anything, to inflation this month, and that'll be kind of an unusual situation for most Americans who are still looking at $4 on their pump prices.
Yeah, exactly, $4 with a tiny fraction after it. Market's still pricing in about a 40-45% chance of a hike in September. After Friday's labour market data, would this seem to be a little more odd?
No, basically what ends up happening is the month-over-month pricing in is cumulative. So you get a 100% view in, as we had almost in September, and that was because they were putting July and August, September together. And now they're just looking at September, and September at this point doesn't look like it's necessarily going to be a rate increase because people are looking at these inflation numbers and thinking the Fed might hold off. But never invest in Fed funds futures because they change every day. And with right now gasoline prices and oil prices going back up again, we'll see what people are thinking when we get closer to the date.
Well, just on that, do we know what Fed speakers we have and what they're thinking?
We only have two this week. One is Beth Hammack from Cleveland, and she has already said she'd like to raise interest rates. And then Tom Barkin, who pretty much always says, I'm open to whatever happens. I want to see what happens before I tell you what I'm going to do. So we're not going to learn a lot this week from anybody at the Fed. We're just going to be in suspended animation.
Is the committee getting quieter, or is it just August?
That's a good question. I don't think we have an answer to that. Last year, we saw a lot of people speaking this week in August. This month, not so much. So.
Maybe they're laying the groundwork for Jackson Hole.
Yes.
Michael McKee, thank you so much, as always. Joining us now is Shana Sissel, Banrion Capital Management founder and CEO. Shana, what's the biggest challenge out there right now for markets that are at records and the S&P just turning green, looking to make another record today?
I think there's some economic headwinds. I know you just talked about what the Fed's going to do next and Fed transparency. The lack of communication from the Fed, this new policy under the Chairman Warsh, is something the market's still digesting, I think. But because we had some disappointing employment information from the labor markets last week, and inflation does appear to be, sticky high, I think there's concerns about a rate hike with softening economic data, and that just leads to increased volatility, especially with less communication from the Fed. And for me, I think that's the biggest challenge for investors right now.
But of course, none of it matters if earnings continue to hold up, and so far, so good. They seem to be.
Yeah, so I think after 2020, and this is something I've just really observed, is that companies and analysts are being much more conservative with their outlooks and their price targets and their estimates for earnings, which has led to more often than not companies surprising on the upside. I can't think of the last time you saw a really disappointing earnings report. I mean, they still happen, obviously, but they're far less frequent than they'd been in the past. And for that reason, I think that we'll continue to see strong earnings just because I think expectations are kept artificially low, better to surprise, under promise and over deliver, if you will.
Shana, will this market ever be able to go back to just digesting quote-unquote regular earnings where we see maybe a little bit of a beat and that's enough to make everybody very happy?
See, that gets back to what I was just saying. I think that we've trained investors now to expect a beat because earnings estimates and forward guidance is intentionally conservative. I think companies are again, looking to underpromise and overdeliver. I think if we went back to quote unquote normal, that it would actually be a shock to investors. I think we've just gotten so accustomed to the way things have been for the last 6 years. So I would be concerned about that. I think that would also attribute to greater volatility for equity prices.
Also, a lot of the spending is corporate profits being shoveled back into other corporate profits and the wealth effect, regular profits for investors being shoveled back into the stock market again. How concerned are you about Main Street, about the consumer, given that we have gasoline still at $4 a gallon and mortgage rates are obviously creeping up when you see the 10-year at 4.68 and the 30-year at 5.22?
Yeah, I am concerned about the consumer. We've had the data between sentiment and consumer confidence has been quite different, and that's unusual. And we've also seen a real difference between higher income consumers and lower income consumers. Lower income consumers are clearly under more stress. So that bifurcation is something that I am definitely paying attention to, and I think other investors should be too. The U.S. consumer never ceases to amaze me at our ability to just consume and buy and buy. I, for one, am an absolute sucker for a good Instagram ad. The amount of stuff that I buy because Instagram fed it to me just speaks to the consumerism in this country. And it really does buoy the entire global economy. So any weakness in the U.S. consumer would be cause for concern. And there is, like I said, a growing divide between the higher income consumers and the lower income consumers, which I'm concerned about.
Yeah, absolutely. So what would you do to hedge then, Shana? I mean, bonds don't look all that amazing at the moment, the way they're traveling. And obviously, the highs could be in some of these areas of the stock market. So what do you do if you just want to maybe take a little bit of chips off the table?
Yeah, so they call me the queen of alternatives because I love talking alternatives and I love implementing alternatives in client portfolios and helping advisors do that. So alternatives are far more available to the average investor, the average Main Street investor than they ever have been before. They're a wonderful tool for risk management and to mitigate volatility in client portfolios. They're excellent diversifiers as long as your expectations are correct. So we run a separately managed account for Wisdom Tree in which we use ETFs to do that. So everything from equity market neutral, something like BTAL, to equity long short. There's all kinds of different ways, alternative income, and now there's products out there that are run by hedge fund managers that have been around for a long time, something like AllW, which is a Bridgewater fund that is distributed through State Street. These are great diversifiers and can really help mitigate risk in portfolios in at times like this where there's a lot of uncertainty with traditional equity and fixed income.
How do you do your due diligence as an investor there, though? I know that you're particularly concerned about private equity and private capital markets and so on. So what do you do if you just need to find out a little bit more before you're willing to hedge in that arena?
Okay, now you're kind of teeing me up to promote myself, but I'll try not to do that. I do think that if you're going to get into the private markets and you're talking the less liquid stuff, so your private placements, your interval funds, you really should be working with somebody who really understands the nuances of not just the strategies themselves, but the structures. A lot of the problems we've seen in private credit have been due to structural mismatches. You really need the underlying investment liquidity to match the liquidity of the structure. And when that is mismatched, you have problems, big ones. And that's what we've seen in private credit, particularly with interval funds. Interval funds on their own are actually a great structure to allow traditional investors, Main Street investors, access to less liquid, but you still need to have that kind of quarterly liquidity. So from my standpoint, that's what you really have to focus on. So working with a professional, I think, can be really helpful. But with the ETF side, again, you just want to look at the type of illiquidity that might be included in a portfolio now, because some do have pockets where they can invest in less liquid securities. But other than that, I would feel comfortable and confident in alternative ETFs, especially in really liquid markets like managed futures and long short equity and things of that nature.
All right. Shana, thank you so much. Pleasure speaking with you today. That is Shana Sissel of Banrion Capital Management. Let's get a check on markets now. And indeed, the S&P 500 has turned green. It is looking to make another record today after that record on Friday, up about 0.1%. The best performer actually in the S&P 500 right now. Akamai adjusted earnings obviously beat estimates, and that stock is definitely reaping the rewards of those results today. It is up more than 8%. On the downside, we have companies like Intel, for example, which is engaging in share dilution. But then if you look at some of the other indices, we have the NASDAQ 100 also up 0.2%, so turning around from the pre-market territory. The Russell 2000 still lagging, down about 0.2%. The VIX at 15, all complacent and quiet. SpaceX had been higher in the pre-market. We have a couple of space companies reporting after the bell today. SpaceX right now down 0.6% at 132 and change. Of course, the backdrop here is that oil continues to go ever higher. Brent above $86 a barrel now. WTI is back above $80 a barrel. Let's take a look at some other movers on our radar with Bloomberg's Nora Melinda.
Hey, Vonnie, we all know tech's been driving the story this year, and I've got 3 names I'm watching in the space this morning. First up, another look at Apple. Shares still down after Jefferies downgraded the stock to underperform. It all comes back to whether Apple can actually convince customers to pay even more for their next iPhone, and Jefferies is betting that that's unlikely. Shares of Apple down more than 2%. Next up, Meta. Shares climbing, seeing the stock to the upside, higher by just below 1%. This is after the company just released a new AI model that's light enough to run on a single computer, allowing users to download and customize the technology. And finally, wrapping things up, Intel lower by more than 3%. That's after the company raised $15 billion through a common stock offering to help keep up with growing demand for its AI products. Those are your morning movers. Danny?
All right, Nora, that stock also off its lows as well. That is Nora Melinda there. Coming up, first it was lettuce, now it's jalapenos. Taylor Farms is pulling products from shelves due to salmonella concerns. We'll get more on the latest recall next. This is Bloomberg Open Interest. Now to high interest to look at what's making headlines around the world. Bloomberg Intelligence sees Shein's valuation at $22 to $25 billion ahead of its Hong Kong IPO. That's below the $30 billion some investors had pushed for. BI's estimate values the fast fashion retailer at 13 to 15 times its projected 2027 earnings. The company was valued at about $100 billion at its peak in 2022. Microsoft is reportedly planning to boost production of its next-gen AI chips. The information reporting the company is preparing to unveil its new Maya 300 chips this fall. It has been in discussions with TSMC to secure manufacturing capacity for more than 300,000 of the chips for delivery next year. Taylor Farms is pulling more than a dozen prepared food items containing jalapenos from retailers over salmonella concerns. The company says it's no longer sourcing jalapenos from a farmer in Mexico flagged as a potential source of a salmonella outbreak. The move comes just weeks after federal health officials tied Taylor Farms to a Cyclospora outbreak. Joining us now is Bloomberg health reporter Jessica Nix. Well, to use another health analogy, this is metastasizing. Jessica, is there some peculiarity about what's going on at the moment? There seems to be a lot of outbreaks of a lot of different diseases.
There are a lot of foodborne illness outbreaks happening this summer. Part of that is brought on by climate change. We are seeing a warmer climate. That means we're going to be seeing more of these diseases. Part of it is also just very interesting that it comes at a time when the CDC and the FDA are dealing with staffing shortages. We've seen the Trump administration cut staff from these public health agencies, and now they're dealing with that on top of compounding more and more of these outbreaks.
So this particular Salmonella outbreak and the Taylor Farms recall, are they connected?
Yes, they are connected right now. So the Salmonella outbreak was announced last week to be connected to jalapenos. The first company, Coast Citrus Distributors, recalled those jalapenos. They were being sourced from a farm in Mexico. Taylor Farms gets their jalapenos from that same farm. So out of an abundance of caution, they went ahead and recalled some of these products that would have been linked to those peppers as well. So far, health agencies have not linked any of the illnesses to Taylor Farms peppers.
Yes, so Taylor Farms is doing this sort of as a preemptive measure, let's say. Do we know yet if the cyclospora outbreak was indeed thanks to those Taylor Farms products?
Yes, that is in fact connected to those Taylor Farms products for iceberg lettuce. There are about 15 states that are reporting cyclospora cases that were linked to the lettuce. The FDA and the CDC are investigating other outbreaks of cyclospora. We're just seeing an explosion of these cases this year right now. There were 2 deaths in Michigan that were linked to Taylor Farms lettuce as well, because those people had eaten at a Taco Bell location.
But there was so much over and back between the FDA and Taylor Farms, and an apology that may or may not have happened and so on. And I think there's a huge lack of trust now. People are just stopping salad eating in general because it's not for certain. When are we going to get, definitive results? Are we ever going to get definitive results of what caused these outbreaks and whether they're under control?
That's a really great question. I think there's so much confusion right now over what we should be eating, what we shouldn't be eating, whether we can trust lettuce right now or the information that's coming out of our health agencies as well. What we do know is that these health agencies are investigating these other outbreaks that are going on, and they will not say definitively what ingredient is linked until those investigations are closed. Some companies are go ahead and pulling some products out of an abundance of caution, like we saw with Chipotle pulling their peppers last week as well. Michigan has said, though, that that's the outbreak epicenter for cyclospora cases. They've said they're allowing people to eat lettuce again. You can go back to eating lettuce because the tainted product is no longer on the shelves and that people should have gone ahead and thrown away those products.
Did it stay restricted to the sort of Midwest states, or did we see both of those illnesses fan out across the country?
We've seen them fan out across the country. For cyclospora cases, it's a majority of the U.S. right now that is reporting some of those cases. For salmonella, we're seeing about 20-ish states reporting cases right now for salmonella.
We'll also see these illnesses come along fairly regularly, right? But then they go away pretty quickly and confidence comes back, whether it's eggs or beef or other different things. How long are we estimating before people start eating salad in droves again?
That's a really great question. I know I have friends and family who are also not eating salad right now as well and trying to avoid it. I think with salmonella, we see this every year. We see about 1 million cases of salmonella a year in the U.S. So this is a more common one compared to cyclospora. That one's a little bit scarier. So I think it's up to people to decide whether they want to go back to trying lettuce again. But we do know it's just linked right now to iceberg lettuce, but they are investigating whether there are other ingredients linked to these diseases.
All right, Jessica, we will trust you to keep us abreast of everything that's happening when it comes to foodborne illnesses. That is Bloomberg's Jessica Nix. Still ahead, we're going to speak with FreightWaves CEO Craig Fuller about the shipping industry as a deal to reopen the Strait of Hormuz remains elusive. This is Bloomberg Open Interest.
We think that the economy is in pretty good shape, although from our perspective, we believe the Fed really should hold steady on rates, and that's what we're calling for the balance of this year. But to the extent the Fed does move, and it's already indicated it has a more inclination to move faster, but gradually, we think the economy is robust still, but at the same time, where our worries are on the labor market, and so that's why we view interest rates being steady is the
What are you
better
so
case.
concerned about with the labor market? It's been kind of this no hire, no fire paralysis, really, for a while.
Exactly. And, you know, I think with the Friday report, it showed the labor economy being a little bit weaker. It's not a really strong source of inflation. And it's really that inflation picture that guides us to say this is not a time to be raising rates.
You know, there's a big discussion right now in the Federal Reserve and, frankly, in markets about artificial intelligence and how inflationary it's going to be versus the productivity boom that a lot of people are talking about. We're seeing, for example, the idea that you are seeing growth continue to accelerate even with some of the inflationary components tied to labor, for example, come in. What are you seeing at State Street in particular of how you're deploying some of the AI tools, the efficiency versus the cost?
You know, I think it is still early days for a lot of companies. I mean, clearly, every single company is investing heavily, as we are at State Street. Where we see tremendous opportunities is with, you know, very significant processes, data-intensive, sometimes very manual efforts, enormous efficiency gains. But we also see revenue opportunities, too, as we think about streamlining our investment process, post-trade, if you will. And then also customizing to clients, being able to provide what we do for very, very large institutions all the way through to individual investors.
We've seen already the financial industry contract a little bit on a headcount front. I just wonder, from your vantage point, how you think about the growth of State Street as it surpasses $6 trillion and its footprint, its headcount footprint, in response to the greater efficiency that you can do? Is it just grow the assets by keeping the footprint the same? Is it potentially shrinking the total size of the employee base versus the overall assets?
You know, we see AI as just an enabler, enabling our people to be able to do more. And so we don't see this really as a headcount reduction play, but more so a benefit to being able to serve our clients even better on a global basis.
Brent moving higher as a deal to reopen the Strait of Hormuz remains uncertain. President Trump is signaling he may favor economic pressure over fresh strikes on Iran, while Tehran is ruling out direct talks with the U.S. for now. Joining us is Bloomberg senior editor Wendy Benjaminson in Washington. Wendy, Iran has suddenly taken a different tone, it seems to me. So this idea of an agreement with Oman seems to be giving them leverage potentially. Is that how you read it?
Yes, that's certainly one way of reading it. But President Trump's tone also shifted dramatically over the weekend. So first, in answer to your question, yes, the Iranians have said that they are close to a deal with Oman on administering the Strait, which will mean, they hope, that they will be able to charge tolls for ships going through. And I'd like to remind everyone that before the war, the Strait of Hormuz was an open international waterway, and you know, shipping got through there all the time without any idea of tolls. But they also published a list of demands for the United States, which is essentially going back to that memorandum of understanding that Trump signed in June, which of course was widely criticized because it gave away the store, many people thought, to Iran. I mean, it gave them everything they wanted, and the U.S. got very little in return. But this weekend, Trump was very quiet. He didn't tweet any threats. He didn't, talk to reporters going to and from his weekend in New Jersey. But he did give a brief interview to Axios in which he said, we're kind of, sort of, we're semi-negotiating was his word. We're low-keying it, he said. And we're just going to sort of wait until he hopes the Iranian economy collapses. I mean, the economy is not in great shape, but the Iranians seem dug in for this. So right now it's just at a slow boil.
Yeah, I mean, the regime is intact. The IMF says contraction of 6% potentially this year, and sure, lots of people potentially below the poverty line, but I would imagine that Iran has more of a stomach for that than the US has a stomach for economic pain before the midterms.
Exactly right. I mean, remember, Iran's not a democracy. The government isn't particularly worried about public outcry, or do they need to listen to public outcry? While people are, in fact, really suffering because of this, and that's a humanitarian problem. But from a political standpoint, you're absolutely right. I mean, there are 12 weeks until the midterms. The Republicans are underwater. President Trump is as unpopular as Richard Nixon was in the days before he resigned the presidency. That is where many polls are showing Trump's approval rating. It's that low. And so, you know, if this goes on the back burner, if this goes off page one for a while, then I think, you know, that's what Trump and the Republicans want. So this sudden patience could be hopefully hoping that Americans forget about this when they go to vote in November.
The other development was the Pentagon asking defense companies to come up with ideas in no more than 21 days for how to ramp up production of munitions and missiles and everything that the U.S. is running short of. I mean, what can they do, Wendy? We've known about this for some time. At least reporting has suggested that we're low on certain munitions.
That's right. There does seem to be pretty wide agreement, except from perhaps the Oval Office, that that the U.S., I mean, it's just a fact. The U.S. sold tremendous amounts of munitions to Ukraine and then have been, very adventurous all over the world in the Trump administration, shooting at things. And so there are not only the need to replace the missiles and air defense weaponry that the U.S. has used, but also they want to upgrade. The U.S. wants to upgrade its air defense and other, defensive capabilities to stop intercontinental ballistic missiles and things like that that may or may not happen in the future. So yes, the Deputy Defense Minister, as Bloomberg reported over the weekend, is asking those companies you were just showing to speed up production and development of these weapons and get them sooner. I think that's all the Pentagon can do is ask. They may, shorten some review times or, things like that, bureaucratic things to speed it up. But that's pretty much the limit.
All right, Wendy, thank you so much for all the context today. That is Bloomberg's Wendy Benjaminson in Washington. Uncertainty over the Strait of Hormuz is keeping pressure on global shipping, with vessel traffic still below pre-war levels. Let's ask Craig Fuller, CEO of FreightWaves, the company that provides real-time data on freight demand, pricing and capacity across the global logistics market. Craig, I want to have a broader discussion with you, but first, any developments around the Strait of Hormuz? Have we reached the cap beyond which, hiring a ship just isn't doable because there is nowhere more for the price to go?
No, I mean, ultimately, the logistics market is responding to this, higher prices for containers, higher prices for shipping. But that's the great thing about logistics companies is they respond to these events. They price it accordingly. And we're seeing freight rerouted to account for this disruption, which is just one of many, many disruptions that we've had over the last, inevitably over the last decade.
What about insurance costs? Do they continue to rise? Do we have any kind of fall off in insurance costs, even when we got the memorandum of understanding?
Well, I think ultimately a lot of the cost, the insurance cost, is priced into the current conditions. While there are some attacks on civilian vessels, I think largely the sort of kinetic conflict is, we'll call it simmering a little bit, but not explosive. And so ultimately, insurance companies and ship owners have understand the risks, and that is priced into the market currently.
Craig, I want your thoughts as well on this new Arctic route that's being reported on today. So apparently a China shipping company is going through the Arctic because polar ice caps melting allow it to traverse from Asia to Europe in 20 days, as opposed to the regular 40 days it takes generally. Is this a route that could take off and help other shipping companies avoid these dangerous choke points?
Yeah, I mean, this has been something that's been talked about for at least the last decade, the fact that the polar ice caps are melting, which will provide new sea lanes. Russia has some ice breakers to be able to clear the lanes. This is one of the reasons that Donald Trump has wanted Greenland, is because ultimately, if you're coming across the Arctic, you're going to pass Greenland, and it provides a much, from a strategic standpoint, provides a really interesting sort of outcome. But this is really a continuation, something that shouldn't be a surprise to anybody, because it's something we've been watching and monitoring for the past at least decade. And it's certainly the dream of the Chinese, the dream of the Russians, to get access to the North Atlantic and the Arctic Ocean, because ultimately this provides, avoids the bottleneck that is in the Middle East and allows them to route more direct traffic to North America.
Craig, just more broadly, port volumes are surging. Ocean carrier rates obviously have gone through the roof, and they're passing on those costs. Energy surcharges have been very, very widespread and are getting more widespread. Truck manufacturing is tightening. All of this is a negative for the consumer and for those that are importing, but it's great news for the freight industry, right? Is the freight recession definitively a thing of the past?
Oh, the freight recession's been over since November, and everybody's celebrating because it's been a miserable existence. Ocean container lines, they were out of a recession pretty quickly. They had about 8-month recession, but trucking has been was in a recession really since 2022, and it ended in November of this past year of 25, and so everyone feels relief. I would dispute your comment about it bad for the consumer, because ultimately, when freight's moving, that is good for consumers. I mean, transportation cost is about 3% of finished goods prices that consumers pay. So even if we see a doubling of freight rates, it's still a marginal impact for consumers in terms of inflation. So ultimately, things are moving. The industry is feeling incredibly bullish, and we're seeing volumes pick up on the international container market as well as in domestic trucking and rail. It's up and to the right for the freight industry, and I think that tells us a lot about consumer activity, but more importantly, it tells us a lot about industrial activity.
Well, just on that point, everything I just mentioned, do they only add up to incremental costs for the consumer? Is this not a significant inflation push at all then?
It's not a huge impact to inflation. Ultimately, retailers will absorb those prices. The biggest risk to retailers and really manufacturers is losing sales. So they will pay the higher freight rates and ultimately eat it in some of their margins. But look, we've seen in the past earnings, this past earnings cycle, that corporate profits are at record highs. So there is some ability for retailers and manufacturers to absorb higher freight rates. Ultimately, they want to get their products into the country. They want to get their products moving to end consumers. So they'll pay the higher rates, and ultimately consumers are going to see a marginal impact, not anything to worry about. What we worry about more about is demand erosion, which right now we're seeing the opposite. We're seeing, particularly in the industrial side, things pick up, and consumer activity looks pretty strong. Consumer volumes, you can look at the container lines. The reason the ports are doing so well is because consumers are buying goods, and retailers are feeling much more confident about consumer activity, which I think is very strong. So I wouldn't take any of the higher freight rates as a concern. Remember, we were at $22,000 in container prices, spot prices, back during the peak of COVID, and we're only at $7,000 right now. So there's a lot of room to go before I think there'll be substantial inflation.
So give us an update then on the intra-freight carrier wars, right? So we have FedEx Freight down more than 4% since its spin-off back in May, partially because Amazon has entered the scene. What's going on with Terrain Grab? Who's winning?
Yeah, I mean, ultimately, Amazon, it's sort of the worst kept secret. Amazon was known to get into it. FedEx spun it off. When it spun off is really a reflection of just how, it spun off at a very high valuation. It's cooled off a bit from where the original spin-off was. There's been a little bit of just, I think, investors have rallied the transports for the last 7-8 months, and really just a cooling off period, a little bit of profit taking. And I think everybody's wanting to see the second half and get confirmation that things are continuing to be bullish, and we're continuing to see things ramp. That is our channel checks have shown that. There's been a bit of modal shift. We're seeing freight move off of trucking slightly into intermodal, which is by rail, simply because there's been a lot of movement in freight rates in trucking, and so that we're seeing things put onto the railroads. And right now, the spread between trucking rates and rail freight is 34%. That is near an all-time high, and therefore the railroads are the primary beneficiaries, and companies like J.B. Hunt and Hub Group that are public are really picking up a lot of share right now.
Wow, interesting. Finally, Craig, and we don't have much time left, but you have advocated in the past for a domestic marine industry, right, to ensure security and supply chains and so on. Are you hearing anything about the administration potentially taking stakes in any businesses surrounding supply chains, the network, marine industry, trucking industry, or anything like that? Any whisperings at all in the community?
Well, I mean, look, I don't think the administration is going to take any trucking investments. It's the most fragmented market. But when we talk about maritime, there is certainly some different bills, executive orders that have tried to encourage maritime investment. There was a story not too long ago about a startup that's going to build ships, commercial ships, that it was originally supposed to go in California, but they moved it to Texas because of some issues with local municipalities and some things that they were not willing to do in California, not a shock, and they moved it to South Texas. So I do think there's a movement and investment, and certainly administration has been very public about wanting more marine investments, is providing incentives. But these, if we're going to build out a marine industry, we're talking we need a lot of money, hundreds of billions of dollars to really restore marine investments in the United States. And this is going to take many years. So a lot of the movement is very slow, it feels like, from my perspective. But it's certainly moving in the right direction, but it's going to take a lot more than where we see today.
All right, Craig, always a pleasure to talk to you. That is Craig Fuller, CEO of FreightWaves. Let's get a check on these markets now as we approach 1 hour and 15 minutes into your Monday session. We have the S&P 500 firmly in the green now. It was lower pre-market after hitting that record on Friday, but plenty of stocks like Akamai, some of the software names. We have obviously some of the energy names also moving higher, helping that stock into the green. Brent crude at $86 a barrel now. It is creeping ever higher in the session, and that 10-year yield also approaching 470 as bonds sell off. Let's get a look at some other movers on our radar today now with Bloomberg's Nora Melinda.
Hey, Vonnie, a few stories I've got for you. First up, TSMC reversing some of those early session losses. Shares higher by about 0.8%. That's after monthly sales jumped 45% to more than $14 billion. And you can probably guess what's behind it, AI demand. The global build-out keeps giving this chipmaker a boost. Also, now let's head to space. Rocket Lab reports after the closing bell today, and Wall Street will be listening for more on its $8 billion deal to buy Iridium. We're keeping an eye on both Rocket Lab and SpaceX shares ahead of that. You can see shares of both companies higher this morning. And finally, an update for you on this M&A Monday. GameStop may be having second thoughts about buying eBay. Sources tell Bloomberg CEO Ryan Cohen is considering pulling his $56 billion bid and going for a partnership or JV instead. So maybe not a breakup, just kind of a different relationship. You are seeing a bit of a mix here with GameStop higher and eBay shares pointing lower. Those are your morning movers. Bonnie?
Nora, thank you so much. And coming up here on Open Interest, Paramount says it will sign an official deal to release 30 movies per year if the Warner Brothers acquisition goes through. More next. This is Bloomberg Open Interest. Paramount has agreed to sign contracts with AMC and Regal, guaranteeing it will release 30 movies a year in theaters if it acquires Warner Brothers. The 3-year agreements would require Paramount to keep the films exclusively in theaters for 45 days and off streaming services for 90 days. Joining us now is Geeta Ranganathan of Bloomberg Intelligence. What kind of a deal is this for the theaters? Is it doable on the part of Paramount?
Definitely is doable, Bonnie, and this is all really part of this whole bigger litigation process. Paramount was supposed to close its Warner Brothers transaction by September 30th. That, as you all know, now has gotten delayed, pushed into 2027. There's supposed to be a trial that takes place in March of 2027. And all this is really because of these antitrust concerns that have been raised by the state AGs led by the California Attorney General Rob Bonta, who has claimed that this will really harm, the merger will really harm Hollywood. And this is basically Paramount saying that it won't, and they will make sure that they have enough theatrical output and it won't affect jobs and it won't affect competition.
Yeah, but these films have to be good, right, Geeta? Or they won't be attracting audiences. They can't guarantee that, can they?
No, that unfortunately nobody can guarantee that, not even David Ellison. I mean, this is a hit or miss business, and we've seen, studios all over the place. Although I would argue this year has actually been a fairly good year for Hollywood in general, but not necessarily Paramount.
Yeah, the box office sales, $5 billion movies in many, many cases. So, you would hope that would continue. But will this put to bed some of the regulatory concerns? Is this the last thing that David Ellison will have to promise, or is there more to come, Geeta?
Yeah, there might be a lot more to come, Vani. I mean, he's obviously hoping that, this is a step in the right direction, that this gets, them, Paramount, to basically negotiate with the state AGs. They obviously want to have some kind of settlement, not really drag this out. And so this is obviously a concession that they're offering. Remember that Hollywood is extremely skeptical after the Disney-Fox merger, because before, that merger went ahead, we had about 20 movies from, both Disney and Fox. That has basically fallen to about 10. So we've seen theatrical output come down considerably, even though Disney had promised that they would not, hurt theatrical output. But, Hollywood has been extremely skeptical, and this is why we're seeing this effort by David Ellison to put this in writing and really kind of assuage those fears.
Yeah, absolutely. Well, incremental progress on the way to potentially a merger. Geeta, thank you so much. Geeta Ranganathan of Bloomberg Intelligence. Coming up, Barrick Mining makes a deal, clearing the way for a US IPO. Metal Spotlight is next. This is Bloomberg Open Interest. It's time for our Metals Spotlight. Barrick Mining falling as it moves closer to an IPO, reaching agreement with Newmont on their Nevada joint venture, which means the Canadian company can list its North American assets in New York. Joining us now is Grant Spora, Metals and Mining Senior Analyst for Bloomberg Intelligence. The stock, though, really suffering today a bit of an investor backlash to some of the moves that the chair, John Thornton, has been planning. Grant, tell us the latest news out of Barrick.
So in order to list its North American business in New York, as you mentioned, Vonnie, it had to clear the way with Newmont and had to come to some arrangement around the Nevada gold mine joint venture. And effectively, the bone of contention was their 4 Mile asset, which is a very, very good resource, but it is exclusively Barrick owned. And they effectively had to vend that into the joint venture, and Newmont had to pay a certain amount of cash up front for that. That benefits both parties because it makes it a much more efficient, streamlined operation. But I think the market is reacting to the price that Newmont paid for the 4 Mile resource. Expectations were probably closer to $4 billion as a payment, and they've now paid around $1.95 billion, or that's the slated amount. So I think there's a market disappointment around the overall payment figure.
So that's definitely a ding for Barrick, but is the market being just a little bit short-sighted here? Are these moves maybe for the long term better for Barrick?
I think on the one hand, definitely to include the resource in as early as possible allows you to be much more effective in long-term resource planning. So I think from a long-term perspective for both parties, it makes sense to put it into the broader complex as soon as possible. So I think on that aspect, the market is perhaps being a little bit short-sighted. However, on the North American IPO, I mean, Barrick is doing this to try and unlock some value in its share price. The company has long decried that, it's being undervalued, and if you look at relative valuations versus Newmont itself, and indeed its peer Agnico Eagle, it trades at a significant discount, which the company contends is not fair. And partly it's because it has a lot of assets in Africa, which are perceived as higher risk. So by listing the North American assets separately, you kind of you make that value visible.
Yes.
However, I'm not so sure that's going to be reflected in the Barrick share price immediately.
Certainly not today, down 8.5%. Grant Spora, thank you so much. Coming up tomorrow, we're going to be speaking with Nancy Tenger of Laffer Tenger, Pooja Siriam of Barclays, and Whoop CEO Will Ahmed. This is Bloomberg Open Interest.